So let me turn to the financial market because everything in the macro story you just heard is now converging into one place, the Vietnam capital markets and the re-rating that we believe is building inside them. We start with the milestone maps. So our call in this timeline have materialized. And we said that Vietnam would pass the March Global Broker Review in March, and it did. So we have FTSE goes live in September. And in April webinar, we guided to around 6 to 8 billion of total inflow, passive and active. And we believe that that forecast still stands today. The next important target is to be included in the MSCI EM index. We will have the central counterparty clearing coming in the first quarter of next year. That is the main structural requirement of the MSCI. The government target the full inclusion by 2030, but we believe that it could possibly be earlier. FTSE is the near-term catalyst, and MSCI is the medium-term upside. How the market has performed year to date so far, and one word for that is resilient. So the market has been through the oil shock, the rate shock, very heavy foreign selling, and still returned 5.2% in US dollars. So in April webinar, we call it a short-term boomback, and in a long-term uptrend. And the first half has proved it. The reason are the ones we mentioned before. A very strong commitment of the leadership to the high growth era, record high infrastructure spending this year and in the next 5 years. We have a very strong export and FDI inflow, as Tung just mentioned, and we have a very high conviction domestic investor who held their belief in the market and the economy as well. And the fundamental engine kept running. The earnings kept compounding. We have 22.6% EPS growth this year, translating to 11.7 times forward earnings. The 22.6% EPS growth translates into around 26 billion US dollar of total profit across the top 100, which is our universe. So the growth is led by the large cap with 30% year-on-year growth, and followed by the mid cap with 24% year-on-year growth, while the small cap still declines. So that tells you this quality is the profit growth is the quality less cycle, not the speculative one. And the profit pool is concentrating exactly where value is invested. The portfolio grow faster than the cover universe. So this is the table that we was very nervous to show you in April. So now this is one of the strongest in the deck. So in April, after 2 months after the war, we revised down the forecast, but said that the downgrade was selective, but not across. However, the second quarter prelim result test that claim, and the forecast was actually revised up. So from under 20% to currently 24.4%. So we have a net upgrade to the worst geopolitical shock in many years. So the upgrade concentrated in banking health firm, residential, metals, and retail were upgraded given the strong consumptions. So that is the earnings power of the market that does not depend on the global cycle. Put price and earnings together, we have a market with growth and trading as a very discount valuation. So Vietnam is the region fastest growth just behind Taiwan, but it's currently trading at only 11.7 times of earnings. It's much more attractive than the market, growing much slower. And we believe that the catalyst to close that gap are the one we have mentioned. So the market upgrade, more local money participation, and more market deepening. So the entry for investor has simply got better. So we have a 50 billion IPO pipeline on the way in the next 3 years. We have 2 flagship deals are ongoing. So Điện Máy Xanh, which is already IPO at around the valuation of 3 billion US dollars, and CP, the largest FDI company in Vietnam, is also going public. So the driver is structural. Private firms need more capital than the capital that banks alone can provide. They must come to the capital market, and the government also realized it too. Additionally, earlier this year, the resolution number 79 also accelerate the state divestment from the state-owned companies, and it will create a supply of assets for us to look at in the years to come. So that is the pipeline that VAL is built to assess. Balance requires, we mentioned the risks, and we will be straightforward. So energy, the ceasefire is on and off. The war has just restarted. Oil has off the peak, but then recover. We don't know how long if the war will continue, and we believe that the inflation pass-through is still working its ways in the economy. The second risk is that the higher for longer Fed rate will limit the SVB room to cut the interest rate in Vietnam. So the policy support in this environment is mainly fiscal, not monetary policies. The tariff has eased globally, but somehow Vietnam is still on the watch list, and we should monitor this closely. However, none of the above risks will change the direction of the Vietnam growing story. All the three risks just affect the pace. For the conclusion, so the market has been stress tested in real time year to date and held up well. The correction for us is the opportunity with the earnings strong, 22.7% EPS growth, and firmer local sentiment. And we believe that the structural re-rating is on the way. FTSE in September, 50 billion or more of the IPO pipeline, and MSCI on the way by 2030. So the question now is, how does our fund VAL turn those catalysts into returns?